Hello, this is Rob Wolf. I will be kind of providing a brief introduction to Morningstar's fund screeners. So from the Morningstar homepage, I've already logged in. You can see my name there. Let's go to Funds. After we go to the Funds tab, we will go to Fund Screeners, Premium Fund Screeners. The majority of our time will be a unique created screening, right? But before we go there, let's look at some of the prepared screeners. This is a portfolio anchor. So this is for probably an equity fund that's going to hold a high percentage of your portfolio assets. Okay, and as you go through the description, it gives some information about what criteria are important. For example, experience management, low expenses, and top half returns. Those are all good advice. Let's see how that carries over into the search criteria. Alright, so fund category is large blend. We'll talk about the style box soon, but large is the capitalization compared to medium or small, and blend is the investment style compared to growth or value. The second is distinct portfolio. Most portfolios are listed in Morningstar under multiple different classes. These are expense classes. We're just going to have them list one class. Okay. The third, fund manager tenure. A variety of different respected resources consider this a valuable criteria for fund searching or fund screening. This is the number of years the fund manager has been responsible for the fund. It suggests that the future performance of the fund will be consistent with the recent performance of at least the last 5 years, and generally when a fund manager has a long tenure, it's because he's done a good job. Expense ratio, less than 1%. Morningstar, almost every academic, and others view costs as a critical part of our investment. And then top half performance. 50 is a percentile. We want the percentile to be in the top 50 compared to the category rank. And then finally, minimum purchase size. Let's go to another screen. And here we can click on this, and let's say we go to Great Bonds, right? It provides a brief description. Again, we can view the search criteria. And there it is. So if you wanted to go through a few of those Morningstar screens just to get some sense of the criteria they use, that would probably be a great idea. After doing that, let's go start our own search. Alright, and when we do so, these are the criteria we're going to search for. You can see it's an extensive list. As you also saw under the Morningstar screen, they only used perhaps 5 to 8 different criteria to find a fund. First of all, fund name. We won't use this in general, but for instance, let's say you wanted to find a Vanguard fund. You could type in the word Vanguard and it would find all the Vanguard funds. Or maybe you want to find a specific fund, Janus 20. You could type in Janus 20 and that would pull that fund up distinctly. So after fund name is fund category. Again, this is very valuable. It breaks down the whole group of funds into these different categories. Alright, these are Morningstar categories. There's nothing magical about this. If you wanted, a fund or a category that was not listed here, there's some other possibilities to kind of narrow in on that. But this is your first cut at breaking down the world of funds into some kind of a subset or categories. Role in the fund, role in the portfolio. There's only 3 that we'll consider. Core is the primary one. You'll probably have a core stock fund, a core bond fund. Supporting player. So you'll have several supporting players as well. For example, the first fund you're going to read about in commentary 1 is Aberdeen, emerging markets. And that is a good supporting player fund. Alright, so this just kind of helps you choose the funds based on their role in the fund. Special type funds, this has to do with index funds, whether or not it's an index fund or one of these other style funds. Okay, index funds is going to be relevant for the core funds, core stock and core bond funds. You may want to choose an index fund. Equity style box. Alright, the equity style box is a box broken down into 9 smaller boxes. There's 2 criteria, large, medium, and small on one side of the box, and then investment style on the other side of the box, value, blend, and growth. You'll see Morningstar uses style box consistently throughout their entire documentation, fund analysis, whether it's in this website or whether it's in the textbook or elsewhere. So the equity style box, we'll talk a little bit about it in earlier chapters, but it helps you to choose characteristics of the fund. Okay, so you can either choose all large regardless of investment style, medium regardless of investment style, or you can choose all value funds regardless of size. Or if you wanted to narrow a specific box, you can see then we have these 9 different specific boxes. Okay. Okay, if you're looking for bonds, there's also a style box for bonds, and these are the criteria. It has two criteria in general. One is credit quality, and the other is interest rate sensitivity. So this would be one set of rows in the box, and this is the second set of rows in the box. And these are each of the 9 different boxes that you would consider for this fund. When we think about bond investing, all right, for your core fund, you're probably going to want high quality, possibly mid quality at the very lowest. Okay. Additionally, extensive interest rate risk, especially in the current environment with extremely low interest rates, would provide a lot of risk to your fund. So probably you don't want anything more than moderate interest rate risk, and some would suggest even small is better. So those might help you kind of choose, right? So you could choose a moderate mid quality, or you could choose moderate interest or limited interest rate and put the or in between those two. And instead of the and, if you put an or there, then it gives you the option of either one of those instead of both. All right. After the fixed income style box, whether the Morningstar analysis is available, I'd encourage you to always check yes. Okay, available. For your own investing, you don't need to do that, but for this class, I'd like you to do that. Analyst rating, that is important as well. Usually if there's Morningstar analysis available, the analyst rating is usually available as well. Distinct portfolio, always choose yes. And rating. So there's the Morningstar rating. Okay, Morningstar rating is a 5-star program, and it basically breaks down the funds into these 5 stars. Now, if you've chosen a fund earlier that's all commodities, it's a mutual fund investing in commodities, this will give you those 5-star Morningstar funds that are invested in commodities. Okay, so depending on the other criteria you've chosen, this will apply to those criteria as well. So 5 stars, these stars are based upon the risk return. So you want to look at securities that have a return performance that exceeds their risk performance. So if their risk is high and their return is very high, could have a high star rating. If their risk is low but their returns are very low, it could have a low star rating. So you can see the star rating includes both kind of a summary of risk and return, and it includes multiple time periods. So this can go back to 5 or 10 years, and if you wanted to know more about it, you can click on the data there, and this provides a great description of the data, of this specific data point. And this view data definition is on each one of those, so you could do that. Morningstar risk, it's included in the Morningstar rating, so it's in some sense double counting, but it's still a valuable criteria. Average moat rating. The moat rating is a little more sophisticated. If you want to read up on moats, you're welcome to use it. I'm not going to include it in this class. Stewardship grade is a new criteria, a little more sophisticated than I'm interested in doing right now. Great. So now we're on performance. If you recall from Commentary 1, Chapter 2 is on performance. So when we look at the whole slew of performance characteristics, generally you want to look at some kind of a performance compared to category or compared to peers. So trailing returns, percent, rank, and category. This is a reasonable one to choose. So what it does is looks at that's not good. So we're looking at trailing returns compared to category. So generally you want a low number. Okay. In this case, it's yield to date. I don't think that's usually the best. Usually it's better if you choose a longer term investment horizon. So for example, I would choose a 5 or a 10. If you choose a 15, you might lose some funds because they've only been around for 10 or 11 years. And a 10 or 11-year-old fund is still a very good fund. So I'd say, choose 5 or 10, and then maybe a 1 or a 3. So I would search it on the 2 criteria. Just because they've done great in a 10-year horizon doesn't mean they're doing great in the current horizon. So I would choose 2 of these to possibly screen on. And then exactly what you want to do, this just shows you the benchmark. So the top 50 have a value of 50 or less. So you want to say less than or equal to perhaps 50. And that would put you in the top half of the yield-to-date return performers. Okay? Again, I wouldn't choose yield-to-date. It's too trendy. It has too many current factors that I wouldn't hold to be relevant long-term. Most investment analysis, except in a very unique application, maybe a day trader would be using something like this, but we're not interested in that for this class. Okay, so there's trailing returns, and that's as good as any. Plus minus category, it's going to be a very similar. It'll tell you how it over or underperformed the category. It's very useful. Generally, I use trailing returns over annual returns. Annual returns, though, would be another acceptable way to search based on performance. Load adjusted returns. Generally, I'll encourage you to avoid funds with a load, so this is not going to be too useful unless for some reason you wanted to include loaded funds. But personally, I would exclude those. After tax return, we're going to assume you're in a tax deferred account, so the tax implications we're going to ignore. These would be very useful if you were going to manage a taxable fund. Standard deviation. I like to look at the standard deviation. Generally we talk about beta more than others right now, but this just gives you some sense of the standard deviation. Standard deviation, the problem with it is it includes idiosyncratic as well as systematic risk, so we're not sure in a diversified portfolio how much of this risk we actually bear. However, it is some measure of the risk of the firm, and to kind of screen on that is not ill-advised. But I may not include it either. It depends on if I was concerned about risk. And as I suggested, the Morningstar risk and Morningstar rating both include some assessment of risk, and it would include this standard deviation as part of that. All right. As you go down here, Sharpe ratios, I don't put a lot of. I do bear market. As I've looked at different criteria, they like to know how the fund performs in bear markets and bull markets. So this gives you an idea how this fund performs when the market's going down. Some people feel as though this can be much more important than how it performs in bull markets. In a bull market, basically everything goes up, but in a bear market, skilled managers should have a lower downturn. Portfolio composition. So kind of knowing what's in your fund. We've already talked about categories a little bit, and so you can use that. I don't use a lot of these, right? But percent cash is one thing you can do. Percent US, percent non-US, percent bond. So those are all possible composition characteristics you might want to look at. Sector weightings. Again, I don't do this. If you're looking at emerging markets and you have a specific regional preference, I was just at an investment analysis and they said they liked Japan. They thought China was a little uncertain now, but they like Japan. And so, maybe you want to increase your exposure to Japan. And turnover ratio is important if you want to look at taxable funds. Also, some of the expenses and turnover ratios are higher. Percent assets in top 10 holdings. So, if you want a diversified portfolio, the top 10 holdings shouldn't be more than, 20, maybe 30%, right? You shouldn't have more than 3% in each of your top 10 holdings. Ironically, as you look at a lot of these funds, there's going to be, 5-star holdings, and those holdings are what's driving the entire performance of the firm. And that's great. It leads to high performance, but it leads to bad diversification. So you want to be a little careful about this. And if you set percent assets in top 10 and you set it at 30, you're going to screen out a lot of great funds. So even though I think it's ridiculous that it's higher than 30, I would still say, right, that it should be decreased. Or I'm sorry, increased to maybe 40. Right. Potential. management and purchase data. Management, fund family score, so different fund families, for example, T. Rowe Price or Vanguard or Dreyfus, those are the fund families, and you can kind of look that up and find out what their score is. For me, fund manager tenure is how long they've been in, and everything I've read, this is a valuable criteria, so I would put that in, and you want it to be greater than or equal to, and then you can just choose a number, right? I've seen people choose 5 in our Morningstar screeners. I've seen 6 in a Forbes article. So I'd say 5 to 10 is a reasonable. You could start, at maybe 8 and see how much it screens out, and then, go higher or lower from there. Fees and expenses, and you want your expense ratio less than, or now it depends. For a stock fund, maybe this could be 1. Maybe 0.8 depending on the stock fund, but you want this to be low, right? If it's your core fund, you want it to be as low as possible. Maybe you want to try to get a stock fund down below 0.5, okay? So you want this to be relatively low. Let's go to the benchmark. Okay, so the top 25 have an expense ratio less than, I'm sorry about that thing, I don't know how to turn it off, and it's never done this until I started recording, and it's driving me batty, but sorry about that. Okay, so the top 25% have an expense ratio less than 0.62. Well, if it's a core fund, right, and it's a strongly diversified large blend, that's not a bad number, right? Maybe lower than that is even better. Okay, 1.23 seems a little high to me, but you can see it goes up very high. All right, so that's the expense ratio. If this is a bond fund, I would even want an expense ratio less. So this benchmark I would suggest is probably for an equity fund. Bond funds should be low. Minimum purchase, I don't have any criteria there. Closed to new investors, I don't have any criteria. For your own sake, if you're really going to use this for investing, I would include a minimum purchase related to what you're going to invest in, and I would choose funds that are only open to new investors. Some funds have been so successful they've closed down, and that's what that's all about. Fund size, sometimes big funds have trouble finding value, but sometimes big funds are well managed, and that's why they're big. There we go again. And that's it. So those are the criteria that I would use. Also, if you go through the Unit 1 commentary, I provide some additional information on this. So if you have any questions, give me an email. And other than that, I hope you have a good time kind of playing with the screener. I would tinker around with it. I would practice and try a few things, and hopefully that'll lead to some good selections for you.